What's going on, traders? How are you? This is Shocks, and this is Shocks Capital FX YouTube channel. Welcome back to the channel. If you are new here, you are welcome. We talk about institutional trading, we talk about ICT and smart money concepts on this channel. So, guys, today our discussion is based on market structure. Our discussion is about advanced market structure, top-down analysis, why some of your order blocks are failing and why you are not realizing it. And today I want to make that clear for you. I want to help you so that you don't get stopped out. So in this discussion, in today's discussion, we're going to talk about structure. We're going to explain the basic market structure. Then we'll go deep into explaining where market structure comes from, and we'll be explaining the Elliott wave theory. Then we will explain the basic market study, the basic market structure you need to know, the basics, and we explain the fractals, the fails, why market structure fails, and we'll be explaining where market structure shifts, what happens, where does it shift, and all that stuff. And we'll be explaining why is it important to know how market structure shifts, where it shifts, and everything like that. So we'll be explaining also the importance of the higher time frame. I cannot stress this enough. The higher time frame is very important in your analysis, in your trading, in everything. So I'll be showing you how it is important today. So how market structure is used in the forex market, it differs from a trader to trader, right? So from this channel, I have taught you guys how to use market structure, right? I've taught you this kind of market structure, right? So if you look at this market structure, what do you see? What you can see from this market structure is number one, it's too basic, right? That's true. It's too basic. You see, this is the market structure I've taught you, and this is the market structure you have learned from books, right? Even from BTMM, when we count levels, say we have 1, 2, 3 levels, right? This is the basic market structure that every trader knows, right? But today we want to really talk about where the market structure comes from. So we explain this as this is the high, this is the higher high, this is the higher high. This is how we explain this is how we explain market structure, right? This is how we explain, this is how we have always explained it. But today we want to look at something that's very very important, right? So this is the high, right? That's correct. This is the high, okay. This is another high, okay. This is the impulse, the three move impulse, right? If we look at Wyckoff, and if you look at Elliott wave theory, where everything comes from, so we are saying market moves in waves, right? So the Elliott wave says this. It says we have one move, so we have 1, we have 2, then we have 3, 4, then 5. So let's say 1, 2, 3, 4, 5. So these are the 5 waves of the Elliott wave. 5 waves, right? What are we saying? We're saying we have wave 1, then we have the correctional wave, then we have wave 2, the correctional wave, and wave 3. So we have 3 major waves: 1, 2, 3. Then we have this correctional wave. This is the basic basic market structure. But if you have realized from your trading, what you can see, or what you would have noticed by now, if you have traded for a very long time, you would have seen that if you draw your order blocks like that, let's say this is the 3-wave theory, right? Then you will see something like this. You see market moving like this. Then you draw your break of market structure. You draw your order blocks in here. Then you expect price to bounce off this order block. Guess what happens? Price moves and takes out this high, and you are wondering what happened. The reason why these order blocks are taken out, it's not because the order blocks don't work or something like that, or any lame reason. The reason is this is just market structure, right? In other words, we are saying this is part of a major or a higher time frame structure. What we are saying is this structure that I have just explained to you here, you can find it here, right? You can find it in the first wave and the correction in the second wave. If you look at this, you can find that, okay, let us change the color of our pen and let me try to show you something very important here. You see, this is not clear. Okay, you see, this is the first wave and the second wave. If you look into this, you can see that we have some major or some minor waves like this. So if we draw this like the, okay, let's just do this. Let's just do this for now. let's delete and let me explain it properly. Now let me explain it the way you would want to understand, right? We have 1, then we have 2, this is the correction, then we have wave 2, correction, and wave 3. This is what we have, right? Then inside these first 2 waves we are going, okay, let's just draw the whole fractal. Then we have this, right? Then we have this, then we are expecting some orbit to hold, then we break everything, right? So we are breaking everything where? Here. Everything has been broken here, and we were expecting price to hold from here, right? This is the orbit that was violated. So we want to see why this orbit was violated. But if you look at this, if you look at this, 1, 2, 2, 3, we have 3 waves, right? Then look at this. This is part of a higher time frame. What? This is part of a higher time frame structure, right? Let's say the green one is the H4, then the black one, let's say it's the M30. So it will do like this, then go up, building up liquidity, go down, then it will then go up like that. Why? Breaking this one. Why? Because it's part of a higher time frame, what? Fractal. So what you see is, if you see, I usually explain it like this to my students. I usually, okay, so this is what you have to understand. I usually explain it like this. To my students, I just explain it like this. I just draw a structure like this. Let's say this is the structure, right? Then I explain it in a way that if this black line, if this black wave is the H4, right? The M30 or the H1 is going to look something like this. Going to look something like this. I don't want it to look like it's simple, right? So this, let's say the green is the H1. Then if you go down to the M15, you will find some waves again inside this one, inside this M15. So what you just need to do is you just have to understand the higher time frame structure, get your direction from the higher time frame as high as you can go, right? I use H4, so you can go there. This is not to mean that you will not lose, or you will not get something wrong or something like that, because the H4, there are higher time frames than the H4, like the monthly. So some order blocks are going to fail. Why? Because it will be following the structure from the higher time frame, like the monthly, the weekly, or things like that. Okay, so if you want to use the H4, for example, you should be getting your entries from what? From the M5, right? You align yourself with the direction from the high time frame, from the H4, then you go to the M5, you get your trade. We're using the H4 direction. Why am I saying that? Because let me give you an example. When we are looking at structure, right? When you're looking at structure, okay, this is the AUD. Let's go to H4. Let me explain something. When the direction or the bias or the shift is about to happen on the higher time frame, right? For example, on the H4, when the H4 is about to shift, when it's about to change the trend, what happens? The signs of the trend changing start to show on the what? On the lower time frame. On the lower time, so we get the signs and and symptoms of a market changing from as low as the 1 minute or the 1 second even, right? So what we are saying is, okay, let's look at this. From this point, we are bullish on the AU. We are bullish from this point. We are bullish. So the higher time frame structure, is what? Is this. Okay, if you look at this, this is the higher time frame structure, right? This is the higher time frame structure that you can see from the one, from the H4. But if you go to the H1, inside this higher time frame structure, you're going to find fractals or other structures. So I call it a structure inside the structure. You guys, I know you have studied trend lines sometime in your journey as a trader. At one point you studied trend lines. There are some trend lines they call inner trend lines and the outer trend line and things like that. So that's the same thing if you're looking at structure. So if you want to be a guru, or you want to be a master of market structure, you have to know that inside a structure, or from a higher time frame, we are going to get a structure that is similar to the structure that you see on the on the higher time frame. What am I saying? Okay, we have drawn this blue as our as our H4. Then we are going to draw another line as our as our H1. So if you look at this, this is the H1. This is the H1 structure that you see. This is the H1 structure, right? This is what I was explaining. You see, the price is moving bullishly here. It's bullish. Then you are going to draw your OB right here. Then it's going to just tap your OB deep and continue going up, breaking this high. Why? Because price is trying to align the H1 with the H4 or with the higher time frame structure. The higher time frame structure is bullish, so it means everything that is going to happen in the lower time frames, it's going to just make waves, but be in sync with the higher time frame. So what do I mean? This is the order block, right? This is the order block. Everyone would have spotted this, and would have marked these lows as your targets. Why? But price doesn't respect that. Why? Because we're saying we are bullish from the higher time frame. Hence, this order block is not going to hold as you would have wanted. Do you understand? So if you were going for 1 in 3 entering, okay, let me give you a very small tip here. If you were to go on M5, right? If you were to go on M5 with this or B, let's just say you know that this is a bullish structure. Then if you have to go on M5 with this order block, you are going to go for 1 in 3, 5 pips, stop loss, 15 pips, and you will be out of the market. You'll be taking money. Easily. Why? Because you are aligning yourself with the higher time frame. So the basic tip, or what I would want you to do, is go from the H4, right? Go to the M5. Then if you go to the M5, you're going for a very small target in terms of pips. You're going for 15 pips, but risk to reward ratio, you're going for what? For 1 in 3, which means you are going to be increasing the odds of you winning that trade with a tight stop loss and a very small target, and you being in sync with the higher time frame. That's going to shift the odds into your favor. You understand? I don't get. I don't know if you are getting what I'm trying to say here, but the bottom line is you have to be in sync with the higher time frame, and you have to know that not every order block from the lower time frame is going to hold. Okay, I remember I did a video some time back, I think last year, that is 2021, explaining the market levels, how to explain the institutional levels, like level 1, level 2, level 3. I was explaining that inside an H4 level, you're going to get like 3 H1 levels, and inside an H1 you're going to get 3 M15 levels. This is the same thing we are doing here. Inside an impulse, you are going to get a structure. Do you understand? If we look at this, okay, let's just look at this. If we look at this impulse, this is a down move, right, on H1. If you go to M5 with the same move, what are you going to see? You are going to see a structure, a bearish structure from the from the M15. Why? Because we are saying price from the lower time frame follows price from the higher time frames. So if this is a bullish move from the if we have a bullish move from the H1 or the H4 or some, okay, this is what we are saying, right? This is our play here. This is like a stretch move on H1 or a bearish move on H1. But what do you see on M5? You see that we actually have a lot of structures inside that single move. You see, we also have accumulation and everything like that. So what do you do? How do you use this information? Okay, let me put it in simple terms. Let's go back to H4, and I'll try to explain to you how you can use this in your trading. So it's simple. We're just looking for 3 things. You're just looking for 3 things if you're trading like this. Okay, number 1, you're looking for an impulse, and you're looking for a move back impulse. So this is the basic structure that we are looking at when we are trading, right? This is the what? This is some order block we are looking at. So price breaks a structure like this. Okay, so let's use this as our order block. So we have our order block in this area. This is the structure that price breaks. This is the high that's price break. This is the H4, right? So what are you going to see from the M5 or from the M15? You are not going to see a straight move back to your order block. You are going to see a move something like this. You're going to see a move like this. Then you're going to see some accumulation, accumulation on the OB. So this is how you're going to trade, or this is how you should be trading if you're not doing that already. So you see, so basically you're going to look for an impulse, you're going to look for an order block, then a break, then a move back to the order block. Then when price gets to your order block, you're going to look for some accumulation fractal, right? It is not going to look like this. Okay, let me just put it in a way. Okay, this is your order block. Price is not going to move like this. Never. It's not going to do that. It's not going to do that from the lower time frame. So what is price going to do? Price is going to come, retest your OB, accumulate inside your OB like this and move. So what do you need to know? You need to understand the accumulation that is going to happen inside your order block from market structure. So when you are to trade smart money, you have to understand market structure and order blocks. Order block. So what we usually say, we have an impulse, a retest, then a point of interest, then you enter. That's our sequence, right? But you need to understand something, that when price gets to your order block like this, it's going to leave one. Okay, let's say we are buying, it's going to leave a low like that, then it's going back, it's coming back and taking out that low, goes up, takes out a high, then comes back to some other block, then goes up. This is the fractal that you are going to see. So in simple terms, it's something like this. Before it retests the OB, it leaves a low like that. This is liquidity. Then it comes, then retest your OB. You are not yet in. Why? Because as you are looking at it, this is a what? This is a bearish move. You are waiting for the move to tell you that it has become bullish. That is the shift that happens on the lower time frame. So this order block is the order block from the H4, but from the lower time frames you are going to see a fractal that looks like this, where you are going to see a low being taken out, then price retesting your order block like this. Then what are you waiting for? After that happens, you're waiting for this high to be taken out. Why? Because you need to see the shift from the bearish market to the bullish market. So the bullish market, so this is the shift. When price does that, it has taken out this high. So what are you waiting for? You are waiting for a retest of some order block that would have caused this move to take out this high. Then when price comes back like that, this is your entry. And look at this. Let's just say this is the M5. You are working inside an H4 order block, and you're looking for 1 in 3 risk to reward ratio. 1 in 3. And you, with this method, you know your win rate is obviously going to be better than 30%, and you're going to make a lot of money using this. Why? Because you're going for what? You're going for 1 in 3. We just want to show you. Just want to show you some. This is 1 in 5, 1 in 3. This is it. So this is how you're going to frame your trade. You have your H4 structure, right? You have your H4 point of interest. You have everything from the H4. From the M15, you are just going to do it like this. You go for 3 pips stop loss, and 3 pips times 3 pips times 3 risk reward ratio. You're going for what? For 9 pips, and you can hit 9 pips. You can hit 9 pips with minimum effort. So let's just look at this. Remember, we're saying this is our order block. Let's look at some charts and try to see if what we are saying here really works. So this is the H4. This is the H4 point of interest. If you go to M5, let's see what you can see, and let's see how we'll be trading this. How we'll be trading this kind of thing. So this is the order block from the H4. So the first of all, let's explain the accumulation that goes in inside this order block. Number one, I said you are going to have a low that is going to be taken out. You see, a low that is going to be taken out. Then what you will be waiting for is a high. to be taken out, so that you know we are bullish. So this high is taken out, then we are bullish. This can happen and you are not in the trade, right? And it's okay. You are not in the trade, and this is your OB where you are waiting your price to what, to come back to. This is your order block where you are waiting your price to come back to. This is the OB. So look what happens. Look what happens. This is this first. This is the liquidity. These are all liquidity. What liquidity pages, liquidity. Then when the high breaks, you know there is a shift in what, in market structure. You know the market structure from the H4 is starting to shift to what, to bullish, and it's aligning with your what, with your M5. So what do? You wait for price to come back to your what, to your order block. You are not involved here. You are not even involved here. Why? Because your OB is down here, and you are going for what, for 1 in 3. Remember, we're going for 1 in 3, and you are not being greedy here. We just want 1 in 3. This is AUD, USD, AU. This is AU, and we're going for 1 in 3. The OB is your risk as always. So let's just say that's the risk to reward ratio 1 in 3. You see. So you're going to hit your TP in how many minutes? 1, 2, 3, 4, 5, 6, 7, 8. In 40 minutes, you are out of the market, and this will happen, and you are not concerned about that. You just take your 1 in 3 and you are out. You are not being greedy. You are not being anything. You just take your money and you go. So this is what you're going to do, and this is what I call a confirmed entry. This is what you are going to be using market structure. So basically, market structure is the same from H4 up to the M1. You just have some structures inside the high time frame structure. So first of all, the high time frame is very important, and you just have to align yourself with that, and you'll be good to go. So guys, this is what I have for you. And just a simple announcement: we are running a special for our mentorship in our VIP. We are running our special for the March class, and we are going to be doing 1 week of intense mentorship. It's going for $100, $100, 100 USD for our mentorship that is going to cover the smart money concepts, the institutional trading, everything. And you're on top of that, you are going to have trader alert signals for a year. So guys, make sure to hit me up on Telegram, and let's see what we can do. Guys, it's been wonderful having you here. I hope you benefited something from this incisive video. I hope to see you in the next one. Trade what you see. I've just shown you some things to see.